The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The AI trade gets a reality check once again. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's talk a little bit about that reality check. You can see the S&P 500 down by about 1.2% right now, a real risk-off trade, and you can see that across asset classes. But I did want to draw your eyes to the Russell 2000 because it's only down by about 0.6%. So that rotation trade, that outperformance of the little guys, it still holds even in a down market. Bitcoin, keep an eye on Bitcoin, down about 4.6% right now. We are below $75,000 a coin. And meanwhile, you take a look at gold rebounding. Of course, we know that the metal space has been all over the place, Romaine, but at least for right now, gold higher by about 5.6%.
Back to the equity market, we should point out we are off the lows of the day, but point out the AI trade, it's really been under strain for quite a few weeks here, and those strains now starting to show cracks. There's no one real catalyst in this shift in sentiment today. But it doesn't really help that NVIDIA and OpenAI are openly squabbling over investment commitments. It doesn't help that Oracle and others are plotting billions in borrowing to fund this fever dream. And it doesn't help that the infrastructure supply chain is still a bit too clogged to even make good on some of those lofty AI promises.
Everybody says there's sort of insatiable demand for AI. I'm not sure we're quite seeing that yet. Investors are rightly starting to question how good the AI spend is for companies' earnings.
NVIDIA down a third straight day, Microsoft a fourth, Oracle a sixth. But the recent sell-off, that's really an extension of a pullback that began all the way back in November, particularly around the perceived risk for software companies. Once the disruptors, now starting to look like the disrupted. Now, to be sure, Wall Street hasn't abandoned the AI trade, not by a long shot, but it is starting to show a bit more scrutiny and rotating out of the speculative positions and into where it sees better fundamental and maybe provable promise. And this isn't just a matter for financial markets. The AI boom, it did keep the U.S. economy afloat through the first 3 quarters of 2025, accounting for at least half of GDP growth, a contribution share that Bloomberg Economics has been projecting would actually swell to about 2/3 of GDP, Katie, here in 2026.
Well, let's put that into context, specifically into this very pretty chart that's behind me. You're taking a look at overall GDP growth. This is a 2-quarter moving average here. And train your eyes over there. This is exactly what Romaine was talking about. When you take a look at 2025, at least the first 2 quarters, in purple here, this is the contribution from IT equipment investment. And then in green, that's the investment into software. You can see that it really built in 2025. And then, of course, you have overall GDP growth, that 2-quarter moving average I was talking about, moving up along with the investment into AI, into IT, into software. So, Romaine, as you said it, I mean, the AI spend, it's been driving these equity markets. We know that. But to a certain extent, it's been driving this economy as well.
Absolutely. Potentially a gift and a curse. As we kick you off to the close here on this Tuesday afternoon with Rebecca Patterson, former chief investment strategist at Bridgewater Associates and now a senior fellow at the Council on Foreign Relations. Rebecca, great to have you here.
Nice to be here.
I do want to talk about kind of the economic ramifications of this AI boom. It certainly has had a net benefit so far. At least we've seen that in the official data. When you look at the concentration, though, of that contribution, is that something investors should be paying more attention to?
They definitely should be paying attention, more or less, I don't know, but yes, attention. And I think there's 2 legs of the stool. There's the data center build out, that CapEx spend from the big AI companies. That's the big driver of growth last year. But another part of the growth is the wealth creation for the people who owned the stocks last year, because they put up some extraordinary gains the last couple of years. And that helped feed consumption, especially the higher income consumers who own most of the stocks. So the best case scenario this year is that maybe a little of the bubble doesn't burst, but deflates from AI. But we see that broadening out that you guys were talking about a minute ago to other stocks. So the overall stock market can keep building the wealth and the CapEx can continue at roughly the same pace. That would be a great outcome for the U.S. economy. My fear is, and the risk to watch, is that if you have enough of a deflate and you don't see the broadening continuing, that can weigh on consumption, that can weigh on consumer confidence. And in a worst case scenario, it actually might cause some of those AI companies to slow down some of the CapEx and disappoint expectations.
Well, this gets to this idea, too, and Katie kind of touched on it with the idea that we are still seeing a rotation. Even on these big days where we have these big sell-offs, you are seeing money still go in elsewhere into the market. And to me, that seems like a sign of a relatively healthy market, even if it's not going into big cap names that will lift the whole market.
Yeah, I totally agree.
Yeah.
I think a broadening would be the best thing that could happen for the stock market, to make it less dependent on a handful of companies, which makes the whole market more vulnerable to idiosyncratic risk around one or two names.
Well, to that point, I mean, you could make the case that we're already starting to see this. Romain and I were having this conversation yesterday. You think about a lot of these mega cap, Magnificent Seven names. For many of them, they haven't hit their peaks since October, since November. And then you take a look at the broader S&P 500 today, notwithstanding. It feels like we're hitting a record high every other day. So, I mean, are you already starting to see that broadening take place?
I think we are. The question in my mind is, can it, will it continue? And continuing means that we need to see those tax refunds get spent. That's already priced into this market. So we need to see that actually happen. Probably will. We need to see inflation stay under control, so Fed expectations can still be a support, not a hindrance to further market gains. Hopefully, we want to see some uncertainty fade from some of the policy announcement. I'm not holding my breath on that one, but it would certainly be additive, right? So, you know, just this week, we got some data that manufacturing confidence was a teeny bit better in January. Now, it's still not great, but it was like a little peak, a little light at the end of the tunnel. And you think, okay, if we could get some relative stability around the trade rules of the road, whatever that means, if we could get that fiscal stimulus from the tax cuts, if we could get this nice rotation continuing, I think that would be great for the stock market and for the economy overall.
But do you anticipate we're going to get that stability?
I mean, I do think the AI stocks are kind of growing into their expectations, and we'll see if the financing and the revenue becoming reality, if the timing works on that. That's a question mark. Assuming that's okay, and assuming this fiscal stimulus gets spent, and we see that pickup in consumption broadly at the beginning of the year, I think we could see this extend. But the uncertainty part of it, no. I think it's a fairly safe bet that that's going to be with us all year. So I think one has to be a little cautious on assuming that the broadening continues. We've seen these small cap rallies how many times now? Like, this is it, and then it dies again.
The false dawn that never disappoints. Well, let's move from one big question mark to another, and that is whatever is going on in metals. You write in your notes to us that commodities are still the story so far this year. And I think a lot of people would agree with you when you take a look at what's going on with gold and silver in particular, the story. But what is the story? Because when it comes to drivers, there's a lot of people scratching their heads.
I mean, they're different stories. Unfortunately, it's not one single story, perhaps with the exception of maybe an inflation hedge and having a real asset in your portfolio. You know, oil, we came into this year, people thought oil prices would be down 10% on this year versus last year because of supply. Now with Iran, and we saw today more premium in the oil price on the back of that drone going after a U.S. ship, possibly. Anyway, so oil's going up. That was not expected. That is not helpful into a midterm election. And the metals whipsawed, again, they went parabolic over the last few weeks. So the fact that we had profit-taking, violent profit-taking, but profit-taking should not surprise anyone. But where do you go from here? Gold, to me, is still a diversification story. It's central banks diversifying. It's people looking for a dollar hedge, an inflation hedge, a crisis hedge. Silver, to me, is much more of a cyclical metal. It's thinking about strategic supply chains, solar panels, those sorts of things. So they're different animals, and silver is maybe a seventh of the liquidity of gold. And so you're always going to have it outperforming on the up and downside.
Just really quickly, though, but that move higher in gold, do you think that was largely about the debasement trade, or was that just more speculation?
The last month or so, I think that was very speculatively driven. And so, again, it's not surprising to me to get a lot of that washed out. But I think there's an underlying support there. I don't think this is only speculators, which is what I would argue for something like Bitcoin. So I think for the case of gold, there is a fundamental support there that would make me personally want to stay in that trade.
All right, Rebecca, always great insights. As always, we should point out gold and silver up again here. Bitcoin in the doldrums and stocks right around session lows. Rebecca Patterson, senior fellow at the Council of Foreign Relations. As we count you down to the closing bells, we're going to get a pulse check on what's going on in Washington, D.C. Gene Sperling, president of Sperling Economic Strategies and former director of the National Economic Council, joins us in just a bit.
Then we'll stay in Washington and look at President Trump's critical minerals push. That conversation up ahead with Barbara Humpton, CEO of USA Rare Earth.
And with all the focus on AI, we're going to get earnings after the bell out of Advanced Micro Devices. All eyes on them. Full coverage coming up here on The Close. Stick with us. This is Bloomberg.
Net asset value financing, also known as NAV financing, it's gaining ground as private markets grow in popularity. Oaktree's Howard Marks says that when used prudently, it can be, quote, a powerful tool, mostly used by successful PE managers aiming to generate value. Our next guest says that the data suggests that NAV financing could become a $700 billion market opportunity by 2030. Joining us live, I'm pleased to say, is Pierre-Antoine de Selancy. He is co-founder and managing partner at 17 Capital, which specializes in NAV financing. First off, it's great to see you.
Good to be here.
So let's talk about that figure, $700 billion by 2030. We're just at the dawn of 2026. Where do you see that growth coming from?
Well, it's a combination of two trends. One is the growth of the private equity industry in general. There are more and more investors coming into the asset class, and that will continue, we believe. And the additional trend is more and more private equity managers are using NAV finance to provide better returns to their investors, to their clients.
And so you point out in your notes you sent over to our producers that, I mean, this has very much been normal when it comes to infrastructure, real estate, and private credit, but it's starting to maybe expand here, converge with other mature private markets. I mean, where do you see that expansion happening from the sector and industry level?
Yeah, the space where we see most growth is the buyout space. Mm-hmm. And really, it helps people managing buyout funds optimize the management of these vehicles and invest 100% of the money they've raised from their investors. And that's a big trend which started probably 15 years ago now and has accelerated with the start of COVID. And it's a sign that the industry is maturing and managers are continue to be more and more focused on their clients and how they can generate better returns for them.
With regards to the maturation of the business, though, I mean, some of the boom that we saw was also partly tied to the idea that some of the traditional exit strategies, certainly last year, weren't always there, at least not for everyone. But there is a lot of optimism that that side of the business might be opening up. Does that potentially hurt you?
I think most of the M&A is back, and last year has seen more than $1 trillion of value for deal value in the US in the buyout space. So activity is definitely back. But actually, the vast majority of NAV finance is there to help make additional investments in companies held by the buyout funds, much more than creating liquidity for the investors. So and the driver there is really competition between fund managers to generate better returns for their clients.
Why is there this perception, though, that a lot of the interests that we've seen in NAV financing and other sort of leverage on leverage activities is about returning cash to limited partners, et cetera? Is that a mischaracterization?
I think there was a bit of that in 2020 and 21, but since then the market has continued to grow, and over 90% of the money going into funds and into NAV finance is to fund add-on acquisition and buy and build strategies. That's really where the money is going.
And it was interesting. I mean, we had the graphic up earlier that you have a 17-year history when it comes to this space. I believe I saw you have over 100 transactions completed. So, I mean, when you look ahead into 2026, a little bit deeper there, what does the outlook look like in terms of activity?
So we're very excited to see 2026 begin very well. Europe has been slightly ahead of the US in terms of use of NAV loans, and we're seeing a lot more activity and appetite among US managers. You know, again, everything is driven by the competition between fund managers. Like if you're an investor in private equity funds, at any point in time, you have between 1,200 and 1,500 funds available where you can invest. And you're going to choose the best managers by looking at the returns, by looking at how well they develop companies, but also how efficiently they manage their own funds. And you manage your own funds if you use 100% of the money you raise from investors, and if you put everything to work. And that's what NAV loans allow investors to do.
Are you seeing opportunities, more opportunities in specific sectors right now that you can share?
No, we're seeing across the whole buyout industry. Maybe software industry is a very fast-growing. It continues to be fast-growing industry. The healthcare industry is also a big user of buy and build strategies and more capital. So we're seeing a bit across the.
Is there any concern about what's been happening in the software industry with regards to some of the sentiment shift? The idea that those software companies that did make a big play into the AI space, that there's some concern now by investors that they may not deliver on some of the returns that they promised?
Well, I think that's exactly why private equity exists, is you can look at a manager with a specific track record, and your investment is not based on macro trends, but really on micro decision. And you choose a good manager because they have an amazing track record and they know how to avoid these pitfalls and build great companies. That's why private equity has this differentiated performance.
And some of the concerns in the software industry, you think that is going to be on a company-by-company basis and not sort of lowering tide, sinks all boats, if you will?
Well, I think if you work with the right managers, the right fund managers, they will have better underwriting processes, and they will be able to identify which companies are weaker on certain points and which are stronger and with better cash flows.
All right, Pierre, really great to catch up with you. Pierre-Antoine de Selancy, co-founder and managing partner over at 17 Capital. When we come back, we're going to turn our attention to Netflix. Co-CEO Ted Sarandos on Capitol Hill right now being grilled about the antitrust concerns around its bid for Warner Brothers Discovery. This is The Close on Bloomberg.
Business model, which was different from that. We didn't own a theatrical distributor before, we do now, and a great one. They did $4 billion in box office last year.
Let's get right to our top calls. Big movers on the back of analyst recommendations. Take a look at FedEx. Bernstein raising the parcel carrier to outperform, boosting the price target to a street high 427. Confidence right now by the analysts that FedEx will deliver a constructive financial outlook at its upcoming Investor Day. Next up, let's take a look at Becton Dickinson. Citi, which suspended its rating last year, reinstating today with a buy for the medical supplies company. The analysts now seeing growth there solid as the sale of the company's life sciences business leaves the company more streamlined and focused. Finally, Adobe. Piper Sandler downgrading the software company to neutral, citing concern over AI disruption and a lack of evidence that app vendors like Adobe, Freshworks, and Vertex can meaningfully monetize their AI efforts. Shares of Adobe down about 7%, worst one-day drop since March, and extending its year-to-date loss to more than 20%. Those are some of our top calls. We do now want to flip our attention right now to Netflix. Those shares down about 4%. Co-CEO Ted Sarandos testifying right now before the Senate's Antitrust Subcommittee to discuss the company's more than $80 billion deal for Warner Brothers Discovery. Though the Senate has no official oversight of the deal, the hearing certainly adding some political scrutiny to a deal that is far from done. Alicia Reese joining us right now, Senior Vice President of Equity Research at Wedbush Securities, who covers Netflix. All right, Alicia, as always, some of these hearings tend to be a little bit performative, but this one is a little interesting, particularly given the backdrop of the Paramount Skydance bid that may or may not be moving forward. Most of the talk right now has been about this idea, and I'm going to quote not Sarandos, but a couple of the senators saying that Netflix deal threatens the viability of movie theaters and will make Netflix the one platform to rule them all. When you think about what a combination of Netflix and Warner Brothers Discovery means, are we talking about a potential monopoly?
Well, it depends on how you define the market. And Netflix is trying very hard to define the market as all of the content that's distributed to consumers right now, all TV viewing, which includes, linear TV and, of course, user-generated content platforms like YouTube. YouTube is their primary argument that they are in competition with the likes of YouTube and other, big tech generally. And if you count some of the content, acquisitions that YouTube has gone after and some of the user-generated content that has ended up in movie theaters recently, you can make that argument. I don't know that the DOJ will, though. And I think the senators, the congressmen are, pushing to, get the DOJ to not include all of that content in this review.
Also wanted to get your thoughts on basically the idea that Netflix would shorten the theatrical window for film releases, because to that point, we heard Sarandos say that the Warner Brothers deal will keep the iconic studio competitive. I mean, when you take a look at some of the particulars here, do you believe him? Do you take him at his word?
Well, I think they have to for, until 2029, the contracts are in place and Netflix wouldn't be at liberty to change those contracts. So through 2029, they would have to at least, go for 45 days exclusive theatrical windows. I think in that time, they would be they would learn very quickly how valuable the theatrical exclusive window is in terms of profitability and also in terms of marketing ahead of a streaming release window. So yes, I do take him at his word, not because of what he knows now, but what he'll learn in the process if they do complete this acquisition.
It gets to the idea, though, too, here, Alicia, of what Netflix is really trying to become here. Let's just assume for a second they do actually get approval for this and fend off a Paramount Skydance here. Longer term, does this become more of a traditional movie studio company, or does it still remain at its core what it's always been, more or less, a streaming company?
I think it becomes both. And, they do seem like they're very interested in gaining this massive library, for all of its merits. On the one hand, on the streaming side, they have, obviously all of those licensing deals that are extremely expensive for them go away because they own the content. And so that's incredibly valuable for them and profitable for them. On the other side, they get to produce all of this content, do the theatrical side, and license to others potentially. So, this is an expansion opportunity for them into different markets, but it also, as Ted Sarandos is trying to make the argument that it gives the consumers more for less, but it doesn't, hinder content production and content acquisition, and that remains to be seen.
And Alicia, we have about a minute left here, but I'm curious. I mean, you have an outperform rating on Netflix. Does that bake in the possibility that they do get this deal across the line, that they do become, really well known when it comes to the film studio and the streaming? Or let's say that this doesn't work out. I mean, would you still be bullish on this company were it just to remain a very dominant streaming platform?
My price target and rating do not include this deal in any way. It includes a little bit of distraction throughout this regulatory process, but it doesn't include the deal right now because I think there are too many hurdles to get this deal done. My outperform rating is squarely regarding the ad opportunity that Netflix has on its standalone business.
All right, Alicia, really great to get some time with you. That is Alicia Reese. She is Senior Vice President of Equity Research over at Wedbush Securities. Coming up, we're talking about the shutdown, the Fed's future, and tariff tumult. We'll have that conversation with Gene Sperling. He is the president of Sperling Economic Strategies and former National Economic Advisors to Presidents Clinton.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Well, the partial U.S. government shutdown, it may be over, but the ripple effects will still be felt. Let's start with Friday's jobs report, which will now be rescheduled for another date. Joining us now to discuss the economic impact is Gene Sperling. He is the president of Sperling Economic Strategies, former director of the National Economic Council, and former National Economic Advisors to Presidents Clinton and Obama. Gene, it's great to have you with us. So, okay, the partial U.S. government shutdown, it appears to be over for now, but we have at least one delay, and it's a big one. It's the U.S. jobs report. And you think about where we stand in the economy right now as it relates to monetary policy, that push and pull between what we're seeing in the labor market and inflation. I mean, what is the potential impact when it comes to delaying this jobs report and understanding the full picture of the U.S. economy?
This is one delay that I found a little bit perplexing. People said to me initially, was it political during the shutdown that they delayed economic releases? And I had to remind people that when I was NEC director during the previously long U.S. government shutdown, that we also had delays in all the economic forecasts. So that was nothing to look at. This is a little more puzzling. Why would a 1 or 2 day delay at this point after you presumably accumulated all of the numbers from the sample week? So first of all, I'm a little more puzzled as to why we're having this delay. But secondly, it really does, as you say, add more uncertainty where you already have a lot of uncertainty. People look at the labor market in very different ways now. You've got somebody like Christian Waller calling for more cuts, more easing due to his sense that payrolls are very weak. You have Chairman Powell saying he expects it to be revised down. People are looking at the low job numbers and they're not sure. Is it due to weakness? Is it due to overhiring from the pandemic? Is it due to AI, or is it due to people having to crunch labor costs due to not pass on the tariff impacts? So this is an area where you have a significant amount of uncertainty. To have this delay in this area is certainly, it's not fatal. I assume it's going to come out rather soon, but I don't think it's helpful in an area where we already have a lot of uncertainty.
Well, let's get an idea too. And there's been a lot of conspiracy theories in the market here about what's been going on with economic data since the last shutdown in the fall. And it gets to this idea, Gene, as to whether there's going to end up being an erosion of trust in the economic data, whether there was anything deliberate or not.
Yeah, I mean, look, I have pointed this out as, so important for a long time, which is that, it fits into a larger issue, which is that part of American exceptionalism is trust in our application of the rule of law, trust in our non-politicization of numbers. I can remember in the 90s how we looked at numbers coming out of China. Even now, do you trust them? How that creates uncertainty. So all of this is part of a larger web, which is that our country benefits from trust, integrity. Now, I will say at this point, despite the attacks on the BLS, despite the delay, I am not going to say right now that I have so far seen something that I would say is should cast doubt on the credibility of our numbers. But it's an area that, due to unnecessary comments by the president, et cetera, has now been put in doubt. So, and this goes to the trust issue. When BLS delays the release of a number like this, when you just have a very short government shutdown, you'd like to be able to say it's all technical, but you're not quite as sure this time. So I'm not going to make accusations, but it does show why you want to take away even a small sense that you would ever be politicizing numbers coming out of the Bureau of Labor Statistics that the whole world relies on for investment decisions.
Right. Well, it is an interesting question, the concept of data quality, credibility, a slightly different point. But when it comes to quality, I mean, you think about the revisions that we've seen to non-farm payrolls, and this was the conversation under the Biden administration as well. This predates, of course, the Trump administration. These very large revisions, you do have this skepticism, these questions about data quality, Gene. And I wonder, what you make about some of the alternative sources of data. We got well socialized with them, certainly during the shutdown in the fall. I mean, how good and accurate of a picture do those alternative data sources outside of official government data paint of the economy?
Well, it is interesting, during the Biden administration, as you know, we had an overwhelming tendency to have job numbers come out that would be improved with later announcements. And of course, that can be frustrating for an administration because you always get the most attention. So 2 points. One is, all those things being said, there's still nothing as good or accurate as the official government numbers. Second thing is, it's not good enough, and we should be investing more. And I think it's a shame that this became a political football, because I actually think this is an area where you could get the very best economists that have both a progressive and a conservative bent and say, how can we improve the data collection for unemployment, et cetera? How can we get more people to report initially so you don't get those swings? But in order to do that, you really have to have a process that would be trusted. I think if I was there, I'd say, let's get two people that have, a Republican and a Democrat that are beyond, repute, who could coordinate a group, and then we should do more funding. So I think I think there's a big difference between saying it's politicized, we should politicize it more, which is not true, or attack numbers you don't like, and saying, hey, for a few $100 million a year, we could increase the number, the job quality, the integrity of the numbers and the trustworthiness of the numbers. And that's not just good for us making decisions or easier for Bloomberg.
Yeah.
It's good for our trust and our credibility around the world.
All right, Gene, always appreciate it. Gene Sperling there, former National Economic Council director. We'll be back in a moment with a closer look at what's going on in rare earths. This is Bloomberg. A push by President Trump to make the U.S. less reliant on Chinese minerals got a $12 billion infusion. He's calling it Project Vault, and part of that also includes a non-binding agreement for $1.6 billion in funding for USA Rare Earth Inc. Pleased to say the CEO of USA Rare Earth joins us right now, Barbara Humpton. Barbara, great to see you here again. Talk to me a little bit here about the commitment by the Commerce Department, and more importantly here, what is the timeline that we can start to see sort of this, earth to magnet pipeline actually start to produce?
Well, this is the reason the Department of Commerce is actually making this tremendous commitment. We've signed a letter of intent with the CHIPS office, the program office there, with the intent to make $1.6 billion in funding available to USA Rare Earth. And the whole reason is because we had a business plan to produce a mine, to be able to process the ore from that mine, to be able to then make metals and ultimately magnets, but over a multi-year period. And the investment by the Department of Commerce would help us accelerate that plan. I'm happy to say that private investors have come along as well. So between the two, we have over $3 billion of potential funding to help us accelerate our plans. With the initial plans would be metal making in 2027, magnet making beginning now, and then bringing our mine at Round Top in Texas online by 2028.
Well, let's talk a little bit about that Round Top deposit, because there are some questions about the quality there. I know that the deposit in particular has been in a pre-feasibility study for years here. So when might we get some information there on the actual quality?
Yes, the Round Top is a really unique geological feature, and it's unlike many other deposits, but it is identified as the USGS as the richest deposit of heavy rare earths in North America. Now, what makes it special is the ability for us to be able to use large outdoor, call it heap leaching, that allows us to process a huge volume of material and then to extract the heavy rare earths from that material. Heavy rare earths are important because these are the high value critical minerals that are absolutely essential for making high performance magnets and the materials that go into everything from semiconductors to fighter jets.
Yeah.
We've proven the ability through some testing that we've done, some pilots we've done. We've had it validated by a third party.
Yeah.
And what you'll see this year is a whole series of scaled up demonstrations and pilots to assure us that our numbers are right.
I am curious, though, too, with regards to the funding from the private side. So have you been in active discussions with some of these defense contractors on that front?
Indeed. Yes, the defense sector knows that they need to actually choose different sources of supply from China. And actually, it's a tricky thing because it turns out these critical minerals and magnets are embedded within assemblies. So it's a complex process that aerospace and defense suppliers are going through to determine how do we get access to the ex-China supplies, the kinds that USA Rare Earth will be bringing online. The conversations we're having today say that they're willing to make commitments well into years from now in order to assure that supply.
Do you have to meet certain milestones in order to get that money, whether it's from the private side or the government? And can you meet them?
Yeah, so glad you asked. The way Commerce has set this up is that the private sector leads. It's investments from the private sector that get this flywheel turning. And then we've developed a very detailed plan with milestones in mining, in metal making, and in magnet making. And only when we achieve certain critical milestones will that unlock funds from U.S. taxpayers.
All right, Barbara, unfortunately, we have to leave it there. I hope to welcome you back soon. That is Barbara Humpton. She is the CEO of USA Rare Earth. Of course, we've been keeping an eye on a lot of these stocks, given the U.S. government has really identified this as a key priority area when it comes to national security.
But it's also, there's a big question, too. And, Barbara, obviously, we didn't really mention it, but, she ran Siemens USA for a long while. So she's certainly got the chops. But it gets to this idea that, this stuff is not easy to produce, certainly not cleanly. And then there's just the question here of the throughput, too, whether it's going to the defense companies or whoever else. So I feel like there's still a ways to go with this.
Absolutely. Well, we'll continue to track it here on The Close. And coming up, we're going to take you to The Close. We'll do that with Mona Mahajan. She is head of investment strategy over at Edward Jones. That conversation up next. This is The Close.
The best case scenario this year is that maybe a little of the bubble doesn't burst but deflates from AI, but we see that broadening out that you guys were talking about a minute ago to other stocks, so the overall stock market can keep building the wealth and the capex can continue at roughly the same pace.
The NASDAQ composite at 1 point down as much as 2.5% on the day. The S&P down as much as 1.5%, but pairing those losses here as we move closer to the closing bells. Katie, I'm not sure what to make of the price action today.
Yeah, pairing losses, but still we're down 0.9% on the S&P 500, even more when you take a look at the NASDAQ 100. That's even though you have a very solid gain when it comes to Palantir, for example, but big tech getting hit today. So too is Bitcoin. Again, off its worst levels of the session, but we are solidly below $80,000 a coin. So you want to keep an eye on that. And gold finding its mojo once again, below $5,000 an ounce, but still looking at a gain of about 6%.
And that's kind of the mixed picture that we've been seeing in the cross-asset space. And you talk about an S&P 500 in the red, but a majority of the stocks are in the green. Maybe evidence here that there is still a bit of a rotation in this market rather than a wholesale sell-off. We should point out here we are going to get several big earnings after the bell tonight. Most importantly, from Advanced Micro Devices. Mona Mahajan joins us right now, head of investment strategy at Edward Jones, to help us count you down to those closing bells. And Mona, I do want to talk about just some of the oscillations that we've seen in the market. The idea that you have a market still sitting roughly near record highs, at least for the S&P 500. But on a day-to-day basis, the volatility that we've seen and the idea that some of the highest weighted companies in this market are not necessarily leading the market, I am curious as to what, if at all, that means.
Yeah, thanks, Romaine. And look, it was a tough day today, but let's keep in mind the broader picture here. It is hard to get overly bearish when we still are looking at an economy that we think is growing above trend, so above that 1.5% to 2% level. We're looking at an earnings growth picture that is still double digits for 2026 in our view, also driven by tech sectors, but also non-tech sectors, so a little broadening there. And by the way, we still think the Fed is on pace to likely cut rates 1 to 2 times. So typically when we think about a bear market scenario, there's two real drivers of that. One, we're heading into a recession, or two, the Fed is starting to raise rates rapidly. So we don't see either of those on the horizon. Now, to your point, underneath the surface, it does feel like investors are looking for spots to either hide or diversify away from technology. We're seeing that in areas across the cap space, so small caps and mid caps, globally, so international and EM holding up better. And then, of course, areas like precious metals, as you noted, have been a bit of that flight to safety trade, although the volatility has been quite high in recent days.
I am curious about that volatility. I mean, we've certainly seen it in the metal side. We've seen it to a certain extent in equities, not so much in the fixed income market here. Is that telling us anything, or is this just kind of, the speculators and kind of the tactical traders kind of taking advantage of the situation?
Yeah, a lot of precious metals, one, is driven by quantitative traders, so that momentum play will always be part of the story there. But two, keep in mind they had parabolic moves on the upside, so a little bit of give back on that is probably the norm or not surprising. What I will say broadly is what really kind of triggered the sell-off last week was the potential announcement of the new Fed chair, Kevin Warsh, who also, by the way, favored reducing the Fed balance sheet. So any signals that we're bringing liquidity out of the system may not be a great sign for areas like precious metals, areas like crypto and Bitcoin as well. So a little bit of that liquidity play came into the forefront last week as well.
Yeah, and it's interesting. You saw that too, sort of in the long end of the yield curve when it specifically comes to those balance sheet comments that you mentioned there. But it's interesting when you think about Kevin Warsh. It seems like the consensus is going to be that it might take a while to get the rest of the FOMC around some of his ideas when it comes to QE. But when it comes to interest rates, again, him being just one of 12 votes. But what do you make of his stance right now? It seems like he agrees with the Trump administration that he would like to see interest rates lower. Do you think that the economy currently would allow for such a movement?
Yeah, it's a good call out. Look, the good news is inflation does seem to be relatively contained, and we still have to get more data points that move us past, the shutdown period. But thus far, what we're seeing is CPI inflation around 2.6, 2.7%. The good news is we know 2/3 of the basket is shelter and rent. We are seeing a little bit more stability in that part of the basket. There is a little bit of elevated inflation on the good side, but there is a case to be made that as tariffs pass through the system over the next year, we could see some moderation there as well. So on the inflation side, we think contained, and you could make the case. We're watching, of course, the labor market pretty closely as well. We unfortunately won't get that data point this Friday, but if we do continue to see any sort of more meaningful softness, we think the Fed has a much stronger case. If we go in the other direction, though, there could be some tempering of that Fed view for 1 to 2 rate cuts.
Yeah, and as we were discussing with Gene Sperling, it's interesting that we are seeing that jobs data delayed, given that it was maybe a 1 or 2 day partial government shutdown. But Mona, I want to go to a line in your notes. I thought this was interesting, that you see compelling opportunities in U.S. large and mid-cap stocks. I feel like the mid-cap stocks are a little bit ignored when it comes to the conversation between large and small caps. What is the profile of a mid-cap stock, and why do you see opportunity there?
Yeah, good call out. Look, I think mid-cap is that nice compromise. The small cap space is certainly having a moment now. I think there is an inflection point in earnings. But what makes us wary of that space in particular is they're much more levered. So, a lot more debt on the books. And there's a lot of companies that are negative earners, or what we call zombie companies. In the mid-cap space, less leverage overall, better earnings profiles of these companies. And by the way, they can still participate when the economy improves and that cyclical momentum picks up. So we think it's a nice compromise of the two. Now, the same kind of beta that you get in small caps, you may not see in the mid-cap space, but we think you'll get a better performance overall.
Mona, always a pleasure. Mona Mahajan, head of investment strategy over at Edward Jones. Counting us down to the closing bells. We're just about 3 minutes away, Katie Greifeld. And I think we need to take a step back and you look at this market here. We actually opened higher on the day, at least on the major indices. At some point, we were down like 2% on the NASDAQ, more than 1% on the S&P. We're well off those lows. The Russell's in the green, transport's in the green. So there is a rotation afoot here.
Yeah, it's pretty interesting, too. And I will point out that you take a look at trading volume right now. It's pretty elevated. I mean, double check me on these numbers, but at least on my terminal, I see 63% greater than the 30-day average. So there's a lot of conviction, at least a lot of money behind some of these moves that we're seeing just about 2.5 minutes before the bell rings.
And it's kind of interesting, though. You look at the biggest gainers on the day in the S&P. It's DaVita, what is that, Dialysis, Teradyne, Ball Corp, Jars. You like Jars?
Definitely.
Palantir's in there, too. So you do have some big tech names in there. But again, it's kind of like, it gets to this idea of that economic narrative, and maybe people are feeling more comfortable with that. A full breakdown of all of today's market action and a full breakdown of some big earnings after the bell. That starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with a global simulcast. Carol Master and Tim Stenovic join us now. Welcome to our audiences across all of our platforms, television, radio, our partnership with YouTube. Here on a pretty wild Tuesday afternoon, stocks open higher. At one point, They saw a huge plunge on the day, Carol Master, but paring those losses heading into the close.
Yeah, we did see some buying over the last hour or so, so we are definitely off our worst levels of the session. Having said that, we've been talking a little bit about and focusing on the home builders. You had a couple of them, it seems like, reaching out to the administration, trying to figure out a way to involve private investors and build some affordable homes. So you did see that sector as a whole up about 2.5%.
Are private investors not already involved in that?
Well, I guess they are, but maybe there's more that can be done.
Okay.
Bitcoin also plunging at one point today, down more than 7%. It's given back some of those losses, now down about 2.7%, but it actually dropped to the lowest price since President Trump's victory. So going back to November of 2024 in terms of price, everything after he was elected essentially being given up.
It's pretty fascinating. I mean, you think about just how Bitcoin has been performing over the past couple of weeks when we've seen gold absolutely on fire, the dollar falling out of bed. Bitcoin didn't really participate at all in that debasement trade and under pressure, as you point out, once again today.
Yeah, digital gold. Hey, you should do a show, Tim Senevic.
1 hour now. Tuesdays, 12 to 1 p.m., Bloomberg TV, Bloomberg Crypto.
All right, there's your plug there here as we get the closing bells in New York. Just a reminder, several earnings after the bell. Mondelez, Chipotle, Clorox, Prudential, EA, Take-Two, Skyworks, Amgen, SMCI, and AMD. We walk you through the numbers here on this Tuesday afternoon with an S&P 500 that opened in the green, plunged about 1.6%. Looks like it's going to close out the day down about 0.9%. The Dow Jones Industrial Average down about 0.4%. The NASDAQ down about 1.4%. While the Russell 2000, that's going to close positive in the green, up 8 points or 0.3%.
All right, back to the S&P 500, guys. 271 names to the upside in the Tuesday trade. Katie, 231 losing ground, one unchanged.
Well, let's take a look at the circle and at the sector performance. A pretty interesting breakdown here. Certainly, you had more losers than winners, and it's the losers that really matter because, as you can see, information technology was your biggest underperformer on the day, down more than 2% as a sector, even though you had a very strong showing from the likes of Palantir. Wasn't enough to lift the sector overall. In terms of what did well today, it was energy. We know that crude prices certainly popped today. Energy as a sector higher by more than 3%, Carol.
All right, so let's go to some of the individual gainers as we await some earnings. And Palantir, number 2 gainer in the S&P 500, and that went up as much at its highs, almost 12%, finishing the day with a gain of about 6.8%. We talked about this company reported after the close yesterday following a revenue forecast for fiscal 2026 that significantly exceeded Wall Street expectations. So we're talking about annual revenue gaining 61%. Company forecast sales in the current quarter of about $1.53 billion. Katie, that was a beat.
And let's quickly turn to Amgen earnings. Fourth quarter adjusted EPS, big beat here. That came in at $5.29. The estimate was for $4.71. So again, quite a beat there when it comes to fourth quarter adjusted EPS. Boosting sales and profits, its top drugs performed there. And again, you can see quite a beat for Amgen when it comes to adjusted EPS and also to fourth quarter operating income as well.
Skyworks, a supplier to Apple, reporting earnings right now, coming in with its fiscal adjusted first quarter earnings coming in at $1.54. That's versus $1.60 year over year. Not quite sure the comparison. Revenue did drop by about 3% year over year, down to about $1 billion. For the second quarter, the quarter that we're in, the company sees adjusted EPS of $1.04, and it sees revenue in a range of $875 to $925 million.
All right, back to some of the individual movers. Got to mention Walmart. This one closing with a $1 trillion market cap for the first time ever. Stock was up about 3% in today's session by the close, a little bit off its best levels of the session. Stock is up about 14% year to date, and that's after gaining 23% last year. So we have continued to see this one move to the upside. A lot of folks, too, it feels like when they come on air, when they talk about the retail sector, they're watching very closely what Walmart is doing. And they have undergone, as you know, a massive digital transformation. So they're using a lot more technology, incorporating AI across their operations, and it seems to be paying off. Investors certainly noticing. And I'm just going to mention home builders again. At their highs, up almost 6% in today's session, finishing with a gain as a whole in the S&P 500 Home Building Index, up about 2.5%. Again, you are seeing that home builders are pushing for some massive programs to develop what they are calling Trump homes that would address the U.S. affordability crisis and allow private capital to deploy many billions of dollars. We talked with our own Patrick Clark, and it sounds like a lot more details, though, need to be figured out before this one might be a go-ahead. But nonetheless, investors moving money into that space, too.
Well, investors moving money out of some stocks today. Those notable decliners include PayPal. Those shares taking a hit today. This after the company said HP Inc. CEO Enrique Lores will take the top job from Alex Chris, whose turnaround plan failed to meet targets. Shares of PayPal falling more than 20% today. Jamie Miller, the payments firm's CFO and operating officer, will serve as interim CEO until Lores takes over on March 1st. Also, looking at ADRs of Novo Nordisk. Those fell today after the company said its sales will drop this year. Blockbusters Ozempic and Wegovy face ever tougher competition, and the company gets hit by U.S. government's plan to cut drug prices. Shares ADRs of Novo Nordisk down more than 14% today. Sales will probably fall by 5% to 13%, according to the company. That's more than the decline of 1.4% at constant exchange rates that analysts expected. The company's CEO said Novo's main aim is to now stay focused on its transformation and to progress the pipeline despite the challenges that are facing the company.
All right, folks, I just want to bring your attention to a headline crossing the Bloomberg terminal that has a stock moving here in the aftermarket. We're talking about Silicon Labs. That stock is soaring in the aftermarket, up about 39% as we speak. And this is on a headline that Texas Instruments and Silicon Lab in advanced talks. Not a lot of detail. I'm just looking at the Bloomberg to see if there's anything more on that, but it just sounds like they're talking. So we're going to keep an eye on this, but it's got the stock moving. And you can see TI down about 3.2% aftermarket.
Take two crossing the wire right now. Their earnings coming out for the most recent quarter. EBITDA at 331 and change. We'll round it up to 332. Adjusted EPS. The company is saying that for the current quarter right now, it sees EPS in a range of 46 cents to 56 cents a share. That does look a little bit higher than what the street was looking for, at least on the top end. EBITDA of 163 to 186, but a pretty broad range there here for what they're seeing here. I just want to point out, too, for net bookings, the company says expect about $1.5 to $1.6 billion. The street, on average, looking for about 1.54.
Okay, you're looking at Take-Two Interactive. I'm looking at what's going on with Electronic Arts. Third quarter net bookings coming in above estimates at $3.05 billion. Net bookings, it's the only data that we have right now, did beat estimates. Net bookings coming in above $3 billion. The estimate was for $2.84 billion. Total net revenue coming in at $1.9 billion. That's shy of other estimates. R&D expenses were a little higher than estimates. Adjusted operating margin at 18.8%. Shares of EA in the after hours down higher, actually, by about 0.4%.
Let's quickly go back to Take-Two there, because it's interesting. We're hearing a little bit from the CEO in the statement talking about outperformance from all of their labels, and then looking ahead as well. They talk about ongoing momentum across many of our businesses and the highly anticipated launch of Grand Theft Auto on November 19th, continuing to project record levels of net bookings. Yeah, it's a good question, right? I know many people would like to know, but still, I mean, projecting a lot of confidence there. You can see the shares higher by nearly 5% in the after hours.
All right, go ahead. Do you want to say something?
Well, I was just going to say, remember we had that sell-off in some of the video game stocks because of that new product apparently being put out by Alphabet. So something to keep an eye on too, as far as the forecast and whether they can meet it.
All right, let's go to the insurance sector. We've got Chubb crossing the Bloomberg terminal. Let's go to fourth quarter total investments up about 1.6% quarter over quarter, $168.72 billion. Property and casualty combined ratio, 81.2%. That's below the street estimate of 84%. Fourth quarter book value per share, $188.59. That's a little bit below the street estimate of $190.16. You can see Chubb just a little bit higher in the aftermarket, up about 0.2%. Fourth quarter net premiums, by the way, coming in a little bit above street estimates at $13.13 billion. So a little bit of movement. All right. On to AMD and a couple of other ones. We're still awaiting for them, including Chipotle, to cross the Bloomberg. I know you guys are going to have it. We will too. But that's a wrap on our cross-platform, radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing on the close on TV, and Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. We need to take a quick break, but we are going to bring you those earnings as soon as they come out of Advanced Micro Devices. This is Bloomberg. Chipotle earnings crossing the wire, the Tex-Mex chain saying, well, for its forecast, expect comp sales growth of 0%. The street was looking for growth of about 2%. That is the full year forecast that Chipotle is putting out. This on the heels of reporting their fourth quarter numbers, fourth quarter comp sales that fell about 2.5%. But believe it or not, that was not as bad as what the street was looking. They were looking for about a drop of 2.94%. Operating margin in the most recent quarter was at about 14.1%, slightly better than what the street was looking for. But once again here, it looks like the real number here, Katie Greifeld, is that 2026 outlook here, basically telling investors don't expect any material growth in same-store sales this year.
Yeah, absolutely. You can see the stock just dropping like a stone after hours, down about 9%. Because to your point, I mean, the fourth quarter look back, a lot of these numbers are in line, if not slightly better than the estimates, but certainly projecting a goose egg for comp sales in 2026. Not something you like to see. In terms of what we're hearing from the CEO, Scott Boatwright, he's talking about this momentum that they saw in 2025. They did open a record number of restaurants globally, and certainly you can see that the numbers that came out, they opened 350 to 370 new or rather that's the projection for 2026. So even with that comp sale projection, they're still planning on opening new locations and expanding that physical footprint.
Absolutely. Boatwright now been on the job for a little bit more than a year. Abby Roach joins us right now, Senior Portfolio Analyst at Allspring Global Investments. And Abby, I know no one was really coming into this quarter expecting a strong forecast, but basically to say don't expect anything, I mean, you got to go back to what, like 2016, 2015, the last time we saw the company really hobbled like this on a growth basis. What's happening?
Very disappointing, and thank you for having me on this afternoon. I wish we were getting a better guidance for 2026, but I think certainly in light of the environment that we're in, my expectation was for them to be a bit conservative with the guidance, but this is lower than the expectation, and I think is certainly not what we expect from Chipotle. Now, it'll be interesting to hear what they have to say on the call as the different drivers behind the guidance, because they've spoken in the past about some of the different initiatives that they have in place to be able to drive comps. So getting a better understanding of how much of this is being driven by the macro and the 25 to 35-year-old consumer versus how much they can do on their end from an LTO standpoint and from a menu innovation standpoint to try to help in the environment that we're in.
Yeah, it's pretty interesting. I mean, some of the issues that Chipotle is dealing with, to your point, they're probably macro, not Chipotle specific, but against that backdrop of this environment, you think about where costs are, where the consumer is. Let's talk about their physical footprint. As I mentioned, they said that they opened a record number of restaurants in 2025. They plan to keep that momentum going in 2026. Do you think that this is the right move for this company right now?
We do. We think it is still the case that they still should be having a healthy growth rate of opening new units. I think it becomes a more important focus for us going forward of if we don't see comp momentum starting to continue, particularly in the second half of the year, if we don't start to see more momentum, I think then we would start to become a bit more cautious around the new unit openings.
I am curious, though, why so many openings? I mean, this is a company that is opening stores. I'm seeing a lot more promotions out there here, and yet is not translating into a material bump up in sales.
It hasn't. And in our conversations with the company, a lot of this has been more macro related versus the new openings for them. We've heard positive commentary from the company around looking at the comps for existing restaurants and for those new restaurants that we're opening. So we think the economics still justify it based on the information that we're getting from the company. But we think if the macro environment continues to be more challenged for the consumer, then they might have to go back to the drawing board and sort of reassess if the growth rate for new unit openings needs to be different than the 8 to 10% that they're talking about now.
Absolutely. Well, Abby, really appreciate your instant reaction there. That is Abby Roach. She is Senior Portfolio Analyst at Allspring Global Investments. Meanwhile, let's take a look at these AMD figures crossing the wire just now. The headline here, fourth quarter adjusted EPS beats estimates. That came in at $1.53. The estimate had been for $1.32 there. Fourth quarter revenue coming in at $10.27 billion. Also heavily ahead of estimates, or healthily that is. The estimate had been for $9.65 billion there. So that's the look back. The look ahead, first quarter revenue seen between $9.5 billion to $10.1 billion. The estimate had been for $9.39 billion, Romaine. So it looks like a beat across most measures at this moment.
The company also saying R&D expenses will be about $2.3 billion in the quarter. That's slightly above what the street was looking for, and about $222 million on that CapEx side here. This gets to the idea here, not so much of the current line of chips that they have, but the idea of how they push forward to rolling out that more powerful set of chips that could maybe potentially be a more viable competitor to NVIDIA.
So a little bit light when it comes to that fourth quarter CapEx. Let's break it all down with Kunjan Sobhani, Senior Analyst of Semiconductors over at Bloomberg Intelligence, joining us right now. So it's interesting. I mean, again, you think about most of the measures here, the look back and the look forward, above expectations. Then you have fourth quarter CapEx coming in a little bit light. Shares dropping right now, down about 2%. Kunjan, what is your first read here?
Yeah, I mean, this is a fabulous company, so the CapEx number is not really that important here. They're not a big spender of CapEx. But having said that, I mean, look, the results overall for the print and the outlook look good, decent, in line with what the expectations was. We believe, again, most of the goodness was driven by the CPU business, which is, I know, not the buzz right now. Everyone's focused on the GPU side, but the CPU continues to be strong, which we like about them and remains an underappreciated side of the story. But that outlook, I think the disappointment, the temporary disappointment in the stock could be because of that outlook figure. I think the high buy-side bogeys or whispers were close to 9.910, so maybe people wanted a little bit more goodness out of this.
So, I mean, on the data center side here, I mean, they talk about that segment revenue, Kunjan, being up about 39% year over year, up to a record $5.4 billion here. How much more of a runway do you see for that growth in 2026?
Yeah, so in 2026, in the first half, unfortunately, this is where sort of they have the pause in terms of strong sequential growth for the GPU, because everyone's waiting for that second half where they will be shipping out their first full rack level solution competing with Blackwell. So most of the growth in the GPU side, again, that's where the focus is, will be the second half related. So not a lot we expect in the first half.
And I'm curious, I mean, at this juncture, you can see the shares are down about 4%. So traders sort of voting with their feet here on their read of these numbers. What are you most interested in hearing from management when we get that earnings call?
Yeah, we would like to really, again, management to highlight the strength in the CPU, which, again, keeps on getting ignored for the timing because of the attention to GPU. But on the GPU side, we really want to see them having continued traction, showing continued success points of their rack level solution, which again will be key, getting good qualification, getting good responses from customers. This way it can soften any fears or any hiccups that they might have and brings up more confidence about their second half. A lot of us, including sell-siders and investors, are going to triangulate into what will be the AI GPU revenue number for 2026 from today's call.
Just curious here, with regards to that 400 chip, what's the expectation for that, Kunjan?
I mean, this is going to be the make or break thing for this company when it comes to the AI GPU story. This is their first full end solution where they can really compete with NVIDIA and start picking up a decent market share. So this has to be a make or break story.
Kunjan, always a pleasure. Kunjan Sobhani over at Bloomberg Intelligence. Quick and smart analysis here of those earnings out of AMD. The share is down about 5% here in the after hours trade. The conference call at the top of the hour, but overall a solid quarter, relatively decent guidance, but still a lot of questions here about the catch up that it might have to do in sort of the new and fast moving pace in that AI trade. Our next guest says AMD actually seems to be more of a bellwether right now than a rainmaker in the AI space. Sarah Kunst joining us right now, founder over at Cleo Capital. All right, explain that for us. I mean, I know they're playing catch up here. Do they become more than that this year, next year, at all?
I'm not sure they do. AI is really hard. We have a lot of big companies that are really winning on chips. And I think that there's been this desire to see AMD kind of break out. But as the froth goes out of the AI market, I think there's an understanding that that's probably not going to happen this cycle.
And I'm curious, Sarah, I mean, you can see that the reaction in shares currently down about 5% after hours. I want to go a little bit further with what you're saying here, that they're more of a bellwether than a rainmaker when it comes to AI. If they are a bellwether, what are they saying for some of their peers in the industry right now?
I think they're saying what we've been hearing for the last couple weeks, which is the AI trade has felt frothy for a while. But that combined with the fact that it's one of the only places to sort of still lock in gains in the U.S. market while we continue to see things that look a little bit like, a weakening consumer, a macro that's pretty spooked by the geopolitics, domestic and international. I think it's part of the kind of sell America trade.
There's been sort of, Kunjan did make a good point, though, too. The idea that obviously it's more traditional business, that CPU business is still generating enough revenue and cash. And I'm wondering if that could maybe potentially be a bridge as they try to sort of work out whatever, they end up coming up with and whether there's actually adoption for it.
Yeah, this isn't a bad company. It's just that when you look at the valuation compared to its revenue, it is an incredibly expensive company. There aren't loads of deals right now that you want to be going into where you're paying a 3-digit PE ratio at a time when the kind of entire global economy is starting to look at AI and say, wait, maybe there's not going to be as much revenue here as we thought.
And Sarah, while we have you, I do want to look ahead a little bit here because we do have some other meaningful earnings this week coming up on the calendar, Alphabet being one of them coming tomorrow. And it's interesting. I mean, you take a look at Alphabet stock really since midsummer or so, it seems like the market fell back in love with this company. And I wonder, you think about those expectations heading into tomorrow. Do you think that the company will be able to meet them, or could we be setting up for maybe a little bit of disappointment?
I was talking about bellwethers, but I am certainly not a fair weather fan when it comes to Alphabet. I've been one of their bigger bulls on the street for when it comes to AI. I've always thought that they would win in this space. I think they will continue to. Will it be correctly priced? I cannot predict that. But I think that you are really, really missing the big picture about who is best poised to make money from AI if you think that Alphabet and Google are not going to be among the winners.
Yeah, I certainly get that. I am curious, though, what you make of some of the ructions that we've seen. I guess we'll call it a rotation rather than a sell-off in that AI trade. The idea of a lot of the software companies being sold off. There's a big basket of stocks that we track here, having one of their worst daily performance in some time. But this has been going on for a while. And it gets to the idea that once you get beyond chips, and maybe, I guess, once you get beyond, I don't know, maybe the search companies, if you will, what actually is that AI trade?
I think that's part of the question right now, right? We got really into semiconductors. I've been seeing a huge uptick in some of, the South Korean indexes like EWY, where you're getting more exposure to things like Samsung. You're getting more exposure to other pieces of the kind of semiconductor and chip supply pipeline. And so you have hardware again over the past few years, which the tech world fell out of love with for a long time. And those are real companies that have been around for a long time, and they're going to continue to do well. But as AI revenue just doesn't spike, I think that you will see some of those slowdowns. And I think that's what a lot of what we're seeing right now with AMD and that sort of cooling off as we get into the aftermarket.
Certainly, shares cooling off right now, down about 4% for AMD. Sarah, have to leave it there. Always great to speak with you. That is Sarah Kunst. She is founder of Cleo Capital. Meanwhile, let's revisit those AMD earnings in more depth. I'm pleased to say that joining us now is Bloomberg Tech co-host Ed Ludlow. So, Ed, talk us through some of the numbers here, some of the investor reaction, because you can see the disappointment in shares. And the big question about this was whether or not we were going to see AMD maybe make up some of the gap with NVIDIA in these results. It seems like, again, a little bit of disappointment on that front.
That's hard to interpret without more commentary from the call. Clearly, to many, the outlook for the current period is quite bullish. At the high end, the street was looking well into the $10 billion of revenue. So that's interesting to see the stock down 4%. I would send you to the area of the release where they're talking about the impact of sales to China in the quarter gone. They did ship some MI308 chips, about $360 million of previously reserved and unreleased AMD Instinct chips to China, and that's weighed on margins in the quarter. They've had to break that out and say that were it not for those obsolete prior generation chips that went to China, margins would have looked better at about 55%, not taking into account those China sales. So AMD can't have it both ways, right? They have managed to ship something to China, not the cutting generation that they're trying to get permissions for, an older generation, but it's hit them on the bottom line. And this is an industry where the economics are brutal and everyone pays attention to the bottom line.
And I had a couple questions. First, let's start off with the memory side of this here and how that potentially holds back the business potentially. And I say that, not to make this personal, as somebody who actually just bought a new computer the other day, and my God, memory prices are high.
Expensive.
But where are we going with this?
No commentary so far, really, in the release, other than it's a risk factor that they will list in the boilerplate. Quarter gone was a healthy beat, right, against what were high expectations. And that's why I'm saying the outlook for the current period also healthy against consensus, at least. It doesn't seem as if that was a constraint on their ability to ship. All of these parts are integrated in the server design. If you're shipping above and beyond on CPU and GPU, then you're going to be constrained on your ability to have the corresponding memory go to it. They will address it on the call, but the numbers don't reflect that.
All right, so when we get to this call, Ed, I know everyone wants to kind of talk about the transition from that 350 chip to the 400 chip. How transparent, or I guess how much information do you think they're able to give us in about 30 minutes' time?
They'll give us a 6-month window of 2H 2026, but investors will want to know the week, day, and hour that the first system goes online, and they'll want to hear that it's in June.
Yeah.
If it's not in June, 2H is a wide delta, right? It's either June or it's December, and that's what the market will judge them by.
All right, Ed Ludlow, the co-host of Bloomberg Tech there, helping us to break down those earnings out of Advanced Micro Devices. That conference call starting at the top of the hour. I know you love tech, Katie Greifeld. You probably love even more politics.
I love politics, and it's interesting. I'm in luck because President Trump, he's participating in a bill signing. As you reminded me, this is about the end of the shutdown, that shutdown bill that, what was it, a 1-day shutdown, a 2-day shutdown?
I'm not sure it even matters at this point. Of course, the second shutdown in the last few months here, a partial shutdown, not to be a glib about it, but now the House reaching an agreement, that bill now on the president's desk as he holds his signing day. We'll be back in a moment. This is Bloomberg. Taking a look right now at shares of AMD, down about 5% here in the after-hours trade. The numbers for the most recent quarter, not necessarily bad, beating on several key metrics, but a lot of people looking forward here, not just to the financial numbers being forecast, but more importantly, what comes next with that company's more advanced chips. Joining us right now to talk a little bit about this is the CEO of Constellation Research and the co-founder of the AI Forum, Wang. Great to have you here, Ray. Let's talk about innovation here, right? I mean, we know that NVIDIA has basically had a chokehold on the market for advanced chips now for the last few years. And there's been a lot of talk as to who can maybe loosen that grip. Based on what we've heard out of Lisa Su leading up to today's earnings report, based on what we saw in today's earnings report, and based on what we may hear on the conference call, are they any closer to maybe doing that?
Well, right now, there is an incredible alternative to NVIDIA at the moment. But when they get out their Helios chips and when they build the racks that are going to come in place, that's going to be the first time NVIDIA is going to have a credible challenge to the GPU dominance that they've had for quite some time. That's what the market's waiting for. But they haven't taken orders yet. They haven't announced as much as they need to. And right now, these are just pure performance earnings, pre-GPU, pre-AI that they've been able to do. And it's a pretty good number there. But once again, the street isn't interested. So this is kind of where we are at the moment.
Well, it gets to this idea, too. I mean, you say the street isn't interested. I mean, what the street is interested in their stories, long-term narratives. I mean, Jensen Huang, of course, has been a master at sort of painting this lofty picture of what his company can be, but also just AI overall. When you look at the communication from Lisa Su, and nobody's taking anything away from her as an executive, do you think she needs to do more?
Well, I think there's an expansive vision that can be said about what they're able to do with GPUs and CPUs and what those future racks look like. And it's just that Jensen has been able to actually forecast a market because he's thinking 10 releases out. And because he's able to think 10 releases out, he can start talking about 24 months out, 36 months out. I think for AMD, they're starting to be able to tell that narrative, but it's going to take them some time to be able to say, hey, here's what AI is going to look like for sovereign data centers. Here's what it looks like for physical AI. Here's our solution for what's going to happen with simulations and the omniverse course, as NVIDIA calls it, but what's going to happen next? And I think there's a little bit of that, and they're also a little bit more gun shy. They don't like to announce things before the release. So it's a different culture between the two companies.
Well, that's Ed Ludlow was just saying this right before you, the idea to basically look for maybe a 6-month kind of a timeline and not much further beyond that. Do you get a sense here, though, that maybe, to use the tortoise and hare example, that maybe the slow pace might actually be potentially winning the race long term?
It's hard to say because the roadmap that NVIDIA has is quite expansive, and I think we're only seeing 10% of what Jensen has in his head and what he wants to share. So I think for any competitor that's trying to jump into this market, they're going to have to build a much bigger, expansive story. They'll also talk about the derivatives. They're going to have to go deeper on what sovereign AI means, what it's going to mean for industries in particular, but they're going to have to go much deeper down to be able to tell that story to counter what Jensen has at the moment.
Well, I want to switch gears pretty dramatically here because Romain mentioned long-term stories, and a big long-term story out there when it comes to AI is the idea of orbital data centers, an idea that has really been socialized by Elon Musk and SpaceX. It's sort of the logic given for why SpaceX is combining with xAI, which is another Musk property. But, I wonder how you think about that. I mean, SpaceX is a viable, mature company at this point. xAI, totally different kettle of fish. They have been burning through cash. When you think about the idea of data centers in space, is xAI a necessary partner to that, or could SpaceX do that and find a better partner in a different company?
Katie, you're absolutely right. It's a story of convenience. I think you can actually build data centers in the sky without xAI, but I think the AI component's important. But if you're within the Elon narrative of where SpaceX is going, and this is the rocket chain to IPO, this is the most convenient story you can tell. And I would say that data centers in space is an amazing idea. It's a great idea. There are different partners that you can do to take that to the market. It makes a lot of sense, especially from an energy perspective, especially from a cooling perspective. So we're going to see a lot of those advancements. Those are things that are 2 to 3 years out, but they're definitely going to happen.
And I wonder, too, I mean, you think about SpaceX, the idea is that they're going to IPO later this year. That is Bloomberg News reporting. And I wonder what you make of that. I mean, does that say anything about the broader AI landscape? Again, SpaceX is a rocket company, but clearly there are big AI ambitions there. Can you extrapolate anything out from that reception, or are we talking about just a story in a league of its own?
I think the story is in a league of its own, Katie. I definitely agree with you on that statement. But there is something here, right? I mean, if we think about what's happening with our space launches, they're also heavily driven by AI. Elon's pioneered the autonomous capabilities for these rockets. We're also going to see the level of precision that's required for space manufacturing, space comms. We also see a whole bunch of security initiatives that are all driven by AI up there. So there's a lot of AI that's going to be used. Do you need a data center in space? I think we're going to need a bunch of them, especially as we start looking at what we do with the moon, as well as the moon and beyond as well. So those are all very important things, but they don't have to be with X.AI.
The final frontier. The future is now. Ray Wang, always fun to talk to you. That is CEO of Constellation Research and co-founder of the AI Forum. Meanwhile, let's take a look at some of the notable movers in after-hours trading. Of course, we are in the thick of earnings season. You take a look at Mondelez, down about 5% right now. Take-Two Interactive, higher by about 5%. Grand Theft Auto coming in November, maybe of 2026. Meanwhile, take a look at Chipotle. Interesting to see losses being paired in the after hours right now. Currently down about 3%. I believe that number was closer to 10% a little while ago. And Amgen, higher by 0.8%.
Yeah, I'm interested in see what they say on the Chipotle conference call here. I mean, a lot of missteps here and a lot of concerns about the broader consumer. Be interesting to see what they say.
Yeah, and a lot of volatility, too, in the after hours. This is the close. Let's take a look at the S&P earnings scorecard. So far, all signs point to a solid quarter, with 80% of the companies that reported before today's close beating analyst expectations. Our next guest says that this paves the way for more earnings growth, even if it's spotty. Joining us live, I'm pleased to say, is Rich Weiss. He is Senior Vice President and Chief Investment Officer of Multi-Asset Strategies for American Century Investments. Rich, it's great to see you.
Oh, good to see you.
So let's talk about earnings season so far. Not necessarily the numbers, what we're seeing in terms of beats here, but the reaction, the reception. We were just joking with a guest in one of the commercial breaks that it seems like it's a tough crowd, especially when it comes to some of these big tech companies.
Right. Yeah. Overall earnings growth, what, 10 to 15% so far on what's been reported. So it's looking good for fourth quarter. Got a nice tailwind coming in. But maybe the reaction's muted because you have so many other things going on that are overshadowing it. That's the only thing I can figure. Or it's already baked in the cake. We kind of knew it. The labor market's been solid. The ISM surveys came out surprisingly strong. So the earnings, the good news on earnings kind of lost in the shuffle of good news. But there's enough, headwinds maybe to counter it.
Well, let's talk a little bit more about that shuffle of news, because one of the big headlines from last week was that President Trump is nominating Kevin Warsh to be the next chair of the Federal Reserve. I want to go to a line in your notes. You asked the question, is Warsh a dove in hawk's clothing? And I think that's interesting because a lot of people have been sort of saying the opposite, that he truly is a hawk. He's just wearing dovish clothing right now. So walk us through what you make of that appointment.
Yeah, I firmly believe he's a dove in hawk's clothing. And I don't believe for a second that the president would nominate anybody who wasn't a dove, right, in keeping with his very explicit policy. So I'm not denigrating it. I'm just saying I cannot believe he's going to be a hawk. And in the past, has he spoken, about raising rates and fighting inflation? Yeah, but that was years ago. This is a different day. So I see him definitely, the talk about quantitative tightening, shrinking the balance sheet, and that'll give him some leeway to lower rates. So he's already negotiating himself or rationalizing lower rates. But tightening on one hand with the balance sheet, lowering rates with the other, that's, what's that? That two-headed llama, push me, pull you. I mean, nobody's really sure what direction that goes in, so I don't buy that either. We're going to see lower rates. And matter of fact, I wouldn't be really surprised if we didn't see full yield curve control. Bessent and Warsh are buddies, and you need the Treasury and the Fed to do that.
We'll talk about that. I just feel like that's probably the more interesting dynamic here, the potential symbiosis between the Treasury and the Fed. We don't know necessarily what's going on behind the scenes now, but it doesn't necessarily seem Jay Powell is always on board with what Scott Bessent wants. These people, they're going to be like perfect strangers coming up?
Oh, I think they're going to be best buddies. They're both on the team. They've shown their allegiance to the White House and the administration. So very possible we're going to see full yield curve control. And again, I'm not denigrating it. U.S. has done it in the past. I think last time was World War II, maybe. Japan's done it with some success. Australia. It's where the Fed lowers short rates, the Treasury pushes short rates, and the Fed pushes on the Treasury pushes on longer rates. And you just drag down those yields across the yield curve.
And you think the market's going to go along with that? I mean, there's been a lot of talk, particularly on the long end, that the market's going to try to fight that.
Right. The bond vigilantes will come out and try to fight it. But they will have to fight it. I believe we'll see it. The bond vigilantes will come out. But so it's going to be a fight. But the Treasury's going to be in there pushing yields down.
But on the Warsh side, why do you think we saw such a big reaction in the dollar, and for that matter in metals, when that announcement came out?
I'm not exactly sure. Two reasons I can think of. One, he seemed to be on its face more hawkish than the other potential choices. So maybe the market liked that, and he's being seen as more independent, which again, I wouldn't bet the farm on that one. The other one is that he alone won't be able to sway, the other members to come over to that side. But I wouldn't bet on that either. The Fed chairman has a lot of sway, moral suasion. And so I would be betting on lower rates to come sooner than what Fed funds futures are currently calling for.
Right. No, it's an interesting point. And we were having this discussion, I think, with Paul Krugman, who basically said that the job of a Fed chair is to be a small-scale politician. You're trying to build a coalition, build a consensus, even though, numerically he is just one vote. But I want to go back to the point you were making about yield curve control, that you could see that coming in the U.S. Is that something that you're investing around, or would you like to see a little bit more evidence first?
Yes, the former. We're investing around, because if indeed they are able to yank down or push down longer-term yields, bodes well for a number of areas of the economy, chiefly real estate, right? Mortgage rates go down. Real estate sector, after being in the doldrums for a couple of years now, could easily race to be, one of the front runners in terms of sectors. So yes.
But on that point, though, too, does it get to this sense here that if the yield isn't there, I mean, even if there's not the bond vigilantes, whether they exist or not, but the idea that you can see maybe some foreign investors retrench, particularly now that you're getting, for the first time in ages, a decent yield in Japan and other places?
Right,
yeah.
right. This whole notion of quiet quitting the U.S., right?
Yeah.
The sell America trade. Yeah, and you got that going on, too. I don't know that that's enough. I don't know that that force is as strong as the Treasury and the Fed. I think they're more heavyweights in that regard, and they'll win when it comes to controlling interest rates at the end of the day.
I also am curious about how you're approaching corporate credit right now. There's a lot of hay being made about you might be approaching some concentration risk when it comes to the publicly traded investment grade markets because you have all of these big tech issuers coming and issuing debt. And I wonder if you see that as a possibility. We talk about concentration risk all the time when it comes to equity markets. Could we soon see it when it comes to corporate credit? Very possible. And the spreads have been so tight. Right, in credit, so we've been shying away from it, moving more towards securitized, mortgage-backed, asset-backed, which are a more liquid and higher-yielding version of private credits, at least. So, very possible. And just real quickly, Rich, the dollar, you're still betting on weakness? Yeah. Lower rates, and again, the administration seems hell-bent on weakening the dollar to help the trade balance, right? Makes exports more attractive, imports more expensive. So I believe that's the way it's going in the short term. And again, we have this, sell America trade. Gold is rising, at least in part because of that. So I would definitely be betting against the dollar at this point, which argues for diversification outside the U.S. All right. Always smart, Rich. Always great to have you. Oh, pleasure. Rich Weiss is the CIO of multi-asset strategies at American Century Investments. When we come back, we're going to go from Rich Weiss to, well, I think everyone here is waiting for this. There you go, right there on your screen. We can get to the names. Tyler Cameron and Tate Madden going to be joining us after the break to talk about their new venture in the home improvement space. This is The Close on Bloomberg. I just want to say, up until today, Katie and I were the two best-looking people on this network, but that's about to change in a big way. Joining us right now is Bachelor Nation star Tyler Cameron and his partner Tate Madden. They've got a new venture in the home improvement space called TINKR. They're already set up a presence in Target and in Home Depot, and they're hoping to expand that. The firm adding Tyler, Cameron, and Madden to their ranks as partners in order to further accelerate that growth. Pleased to say that Tyler and Tate join us right now. Hey guys, great to see you here. Let's talk about the growth of this business. And first, well, let me just back up first. First, let's just start off with what this actually is. It's basically, we're talking about tools, home improvement things, but I guess a little bit more accessible for those of us who aren't like, hardcore contractors or things like that.
Yeah, DIY is very intimidating, and our whole goal at TINKR is to make it something that we can all do and all use. These are tools that are very approachable, but we also want to be a hub for people to learn. So DIY is less intimidating, and this is the one who does all the DIY here. So she's the one who I kind of learned from. Well, talk about just, go ahead, Tate. I'm curious just about the idea of actually managing a business as well. It's one thing to just lend your name to something, but when you're actually integrated in that process and you really have skin in the game, that changes the dynamic a bit, doesn't it?
Absolutely. I honestly stumbled upon TINKR myself. I always felt like I never had anything that I kind of gravitated towards when I walked into, a Home Depot or a Lowe's. And when I spotted the TINKR toolbox, it was the first time that me, especially as a woman, saw something that was pretty. And so I bought the tools thinking, oh, this is such a pretty toolbox. But then once I got it home and I realized, wow, these are actually really good quality tools as well. That's when I went to Tyler. I was like, I think these people are really onto something. There's never been anything like this in the market that, especially for me as a woman again, kind of is, gravitated towards when you walk into a store. And I thought that was so cool. And to have the quality behind it as well was just really unique. And I knew after that we had to figure out some way to be a part of it.
Well, it's interesting because, it would have been easy, I'm sure, for you guys to sort of sign on and endorse TINKR rather than become partners. So talk us through a little bit about that decision, putting skin in the game beyond just endorsing TINKR.
Yeah, no, I think, when we found TINKR, it was, is this actually quality stuff? Is this stuff that I can use and not mess up or break? Because I tend to break a lot of things, but when I got my hands on the drill, on the whole toolbox, I found out this is great quality stuff. So then I was like, there's a real business here. I want to put our names on this. I want to put fuel to the fire here. I want to, TINKR to be known as the how-to destination. So, we're already in this space with renovation, construction, real estate. This is a great way to include everything that we're doing now with TINKR.
And so, Tyler, in addition to you both being partners, Tyler, you are head of product. Tate, you are head of creative. How do those two roles work together, if at all?
Yeah, I think on my end, being the creative, I think, again, not having something that is aesthetically pleasing in this market yet, I was very excited to jump on board. I do a lot of the design aspect in our renovations, and I also do a lot of the DIY and the projects just in general for us when we're renovating homes. So to be able to kind of continue on with what's trending design-wise and also bring in, the tool aspect of it was really exciting for me, and something that I think that I had a good hand in on both ends. So it just made sense for me.
What sparks my interest for it too is TINKR is in so many, we have a painting kit, we have a wall patch kit, we have a tool kit, we have a furniture assembly kit, but there's so many things in the future that we want to do as well that we're really excited about. So being in charge of product, making sure this product works well, it can be used on, throughout the house, but also on a job site, and so this is something that we believe in and we're excited for the future because there's so many great products that we could put TINKR's name on and build out and make very special throughout the house.
So is there a sense, though, too, as you're selling this, particularly for those folks, anyone who's bought a home, at least if you're not, it didn't have that experience, it's always kind of a challenge that first year of just kind of learning how to fix things yourselves. Are you providing sort of guide for people, sort of instructions of exactly how to patch that wall? It seems simple in hindsight, but when you first approach it, it's like, oh my God, I have no idea what I'm doing.
No, usually I call Tate and have her do it all. But what's so great about TINKR is we have a barcode that you can scan, and it'll have videos of everything that you need to do, how to use it, what to learn from. So our whole goal is to be a hub of education. We want to build a community where people can get together, they can learn, they can talk to us about what they have problems with, what they need help on. But TINKR is making DIY much more accessible.
Well, we really appreciate you guys stopping by and telling us about it. That is Tyler Cameron, head of product, and Tate Madden, head of creative over at TINKR. Really interesting conversation there. And we have more earnings, Romaine.
Yeah, I guess we could have gone a little bit longer with them, but we have to get back to the earnings. SMCI out, the shares higher in the after-hours trade. The main headline here, the company's net sales coming in above estimates and guidance for the current quarter. 3Q net sales, $12.3 billion. The street was looking for $10.25 billion, so a guide well above street estimates. Full year guidance of $40 billion. The street was looking for, or excuse me, its previous guidance was for $36 billion. So basically a beat and a raise here for the quarter. And I guess it gets to this idea, Katie, really about the sustainability of this AI trade and the idea that there still is some juice there. It just may not be in the names that maybe everyone bet on in the past.
Yeah, absolutely. Though I will say Supermicro, we know that they've had some idiosyncratic issues. Certainly the stock has been a roller coaster, but you can see higher by about 7.5% right now, Romaine.
All right, let's set you up for what to watch over the next 24 hours. A lot more coming down the pike here, including more earnings out of some big ones. Katie Greifeld.
Yeah, absolutely. Alphabet, Qualcomm, and ARM. We also have Snap, Eli Lilly, Uber, and AbbVie. So, yeah, a lot to keep an eye on.
Yeah, and of course, we'll have full coverage of that on the close tomorrow. But before we get there, we get some economic data, the ADP employment and ISM services numbers. And at 12 p.m. tomorrow, Katie Greifeld, what's happening?
It's the premiere of the Deal Show. Definitely looking forward to that. We know that deal making is back, and now we have a whole show about it.
Yeah, a full hour. Danny Berger going to be your guide for that. We really encourage everyone to tune in, 12 p.m. New York time, and we really encourage you to stay tuned right here on The Close every day at 3 p.m. Wall Street time. This is Bloomberg.